and we'll dig into it. I hope everybody's doing well. Hi, Kenneth. Hi, Lon John. Hi, Lon Jeff, Submariner. Tim, I know Eric in Northport's here somewhere. Good to see you guys. Eric gets in here at 8:34, so I don't know what everybody else is doing, but it's good to see everybody. And currently looking at adding. Let me do this real quick. Let me share my screen, and we're going to dig into this. So today, obviously, there is a big story. I don't think I need to tell you what it is, but last night, uh, military action by the Israeli military against Iran. We're going to talk about this, and I'm going to be as down the middle as I possibly can. And we'll talk just about this kind of gray swan. This is one of those events that I go back to my time at in global security studies, that it was always inevitable. But the question was, what are the outcomes going to be? And my focus here is I got to keep my eyes on the numbers for you to help you understand how prices are going to move. Because if we have any previous, recent event that transpired that would impact the energy market and everything else, it was obviously what happened with Russia and Ukraine. This is a different story, but it is very, very critical. So we'll dig into this. And because it is Friday, and because we expect quite a bit of movement in the market as people reposition and change their specific positions and try to hedge and try to address what's happening in the markets, this is a perfect day for volume weighted average price. So we're going to talk about VWAP, some of the names that we should be watching, some of the names that you should be trading today, because there is going to be ample opportunity. You just have to know exactly where to look. And then obviously that's the entire purpose of this show. So once again, why are you watching me? Why are you up here with me at 8:45? Because if we're looking at your portfolio at 9:30, it's too late. So we're going to give you the 5 stocks that are worth engaging. Actually, the list is a lot bigger today. We'll talk about this market, what sectors are actually on the move, what sectors are worth speculating on, and what sectors are not, right? Defense waking up. Kratos, stock that we have been long on, talked about quite often. Another big move today. Lockheed Martin coming off its 50-day moving average. We'll talk about that. But it's the energy market that is obviously at the center of everybody's attention. And I want to show you one specific chart because I was asked if I could set something up over the longer term and say, what are the trades that I'm specifically looking for later this year that I think are going to be very high conviction, but also potentially lead to massive returns. It's not going to be oil moving up. It's going to be oil moving down. And I'm going to explain that momentarily. And we're going to see how smart money is positioning. And I'm going to show you how quickly smart money leaves the market and how violent those moves are. And the last thing that I want for you is to be a bag holder in any of these situations. In this current situation right now, HP, one of the drillers, very strong. Apache, you know that I've been talking about Apache. I am, the trader in me is saying to myself, oh, I had that $18 call for that expired today. I took it a 67% gain. It would have been worth 200% waking up this morning. But that's just how the markets are. You take your gains, you walk away, you're happy with it, and now the opportunities will start to form on the other side. Occidental, back in focus, name that I love to trade actively. If you're interested in Occidental, one of the things we'll talk about next week is how to use spreads around the stock. And Kratos doing very, very well. Stocks that are weak right now, and there will be a lot of weakness. One of the things that I do in this environment is I tend on Thursday to look at stocks that have potential breakout conditions, particularly in the small cap space, starting on Fridays into next week. Well, all of those smaller cap momentum stocks are breaking down. And there really isn't a way to trade them because there's really not a lot of optionality with it. And because third Fridays next week, I don't want to be speculating on any of those names, but some of the bigger cap names, NVIDIA, BLDR, those need to be on the watch list because I want you to keep in mind today there's going to be a lot of news. There's going to be a lot of chop. There's going to be a lot of change. There's going to be some rotation. But the thesis for NVIDIA and the thesis for BLDR still remain in place. And this goes back to the conversation we had yesterday that there are these trends, great trends, things that you want to invest in or trade for the long term, but you have these short-term air pockets that lead to people taking profits, kind of a reset in momentum. NVIDIA does not go straight up. In fact, NVIDIA can and will trade in a pattern that's very, very heavily dependent on broader market momentum. And you could see you have these violent up and down moves. If you're long a company like NVIDIA, or you're just getting into the game of AI, owning NVIDIA to the upside for the very long term might be a great play. But the problem is the bulk of people are not going to hold it that long. Keep in mind the average stock is only held today for 6 months. It used to be 8 years in the 1980s, or forgive me, in the 1960s. But there were significant changes. The first thing was it was very difficult to exit positions in the 1960s. You didn't have these brokerages that we had today. People were in it for the long haul. Today, it's very emotional, it's very behaviorally charged. People don't hold things, people trade things, and they certainly aren't as focused for the long term as they used to be, particularly in an environment where we are having a major crisis every year. And we have had a major financial crisis. Talk about black swan level, once in 63 years, in some cases, one in 10,000 years. All have happened since 2022. And obviously, we had another big event that happened in 2020 and 2018 and 2015, 2011, 2008. We are children of perpetual crisis, and therefore we behave like that, right? That is just kind of baked into our ecosystem. So I want you to just keep in mind that yes, these trends are great for the long term. You're going to do better trading them, especially if you understand and you're educated around the technicals that drive this. XOM getting a bid today. Apache is very, very strong. I also want you to keep a very close eye on the defense sector. DFEN, right? This is the leveraged ETF that we track on defense. And it recently came down, tapped off its 20-day moving average, and now we're starting to see strength again. One of the more important lessons that I think a lot of traders have to understand when it comes to momentum is that it's very difficult to time the top. I will say that Professor Bierman is a pro at this. He's one of the first people that I have met who will sit here and just say, yep, called that top. And then all of a sudden the stock tanks. I'm not as adept in that. Really, in fact, where my study has been always built around is trying to identify the reversals at the bottom because that's typically where that's where I've been educated. And what I have seen in momentum is that prices can remain stronger and things can continue to move higher. And that is a very difficult thing for people to do. They'll step in front of they'll step in front of this market. And it takes a lot of conviction to do that. I'm not willing to do that. I want to focus the other way. So I just want to point out that when it comes to defense, strong stocks can get stronger. And this is a really interesting environment for names like Lockheed Martin coming off that 20-day moving average, coming above that 50-day moving average, that pop. This has my attention. And now I'm looking for strength as the RSI, MFI, MACD, and ADX all are in alignment. We're seeing this move above 50. I want to see a little bit more institutional volume. I want to see a little bit more flow in the MFI. But Lockheed Martin can run, definitely run in this environment. So Lockheed's at one of the tops of my list right now. All the other defense names, NOC has gotten a lot of attention as well. This is Northrop. And once again, strength coming off that 20-day. And as I've noted, really good things can and will happen off that 20-day. I'm more likely to trade Lockheed today than I am to trade NOC. But as I noted, this is a volume weighted average price day. And momentarily, I'm going to walk you through how we set this up and specifically what we're looking for because all of these names have options that expire today. You can call that zero date, but really, at the end of the day, these options set up, they originally were always on third Friday. Then they started to do weekly Fridays. And now we're starting to see the bigger names, the NVIDIAs of the world, the Apples, they're going to start to have options on, I believe, Tuesday, Thursday, and Friday. So there's going to be a lot of liquidity and a lot of trading around these individual options, which is why it's really important to get that education on zero date because this is the direction the market is going. There's going to be more faster, bigger trades on the intraday level than there will on, kind of that 5 to 6 weeks, 6 week tracking. So it's important that we give you that education in zero date. And don't worry about it. It's not as intimidating as you think it is. It's actually quite simple when you set the rules and you understand the explicit technicals that I'll be discussing. Take a look in the chat. All right. Thank you, Dave. I appreciate that. Please tell other people. Where's Bert? Tell Bert. All right. Big story today. And we're going to use security analysis. We're not going to use the security analysis of Ben Graham. We're going to use the security analysis of the global security studies at Johns Hopkins, where I studied in 2009 to 2011. And I did have to take courses, even though the bulk of my education was built around the financial markets and economic policy. We spent an incredible amount of time on military policy and military security. So let me give you kind of the background on this. And this is, again, I'm going to be as straight down the middle as I can on this and just give you the facts on this. Israel drew a red line. Israel, across multiple administrations, stated that a nuclear armed Iran was a threat and would not be tolerated. And when red lines are drawn, and they're clearly drawn in the arena in which we operate, inaction undermines deterrence credibility. Very important. So it's not just with adversaries, it's also with allies and domestic audiences. So if you tell your population that you're going to take a stand on something and you don't, obviously you can see what can happen politically. The strategic doctrine began roughly 1981 with the attack on the Issarak reactor in Iraq. They have a preventative strike doctrine that they have maintained. And in addition to that, 2007 in Syria. And the logic behind this is if an adversarial strike is on the brink of acquiring nuclear capacity, a preemptive strike is not just permissible, it is viewed as strategically necessary. The core thing in this is, at the end of the day, there has been all of this talk and chatter for years about the JCPOA framework. Tel Aviv has consistently expressed skepticism on US-led diplomatic efforts around the nuclear deal in Iran. It's viewed them as short-term delays rather than actual permanent rollbacks. And Washington pivoted toward broader regional stability and greater competition power with China in recent years. Israel effectively had determined that it could no longer outsource that deterrence. So Iran has always been expanding its regional footprint. Hezbollah is in Lebanon, the Shiite militias in Syria, Iraq, and the Houthis' missile technology. That created asymmetric pressure on their borders. The strategic patience risks encirclement. So that forced Israel to choose between a reactive defense and an aggressive rollback. And once Iran's nuclear infrastructure is hardened and dispersed, a kinetic strike becomes exponentially more costly and less effective for Israel. So from a military planner's perspective, now may have been the last viable moment to actually take action on this. Israel's governments often operate under coalition pressures where national security is security posturing carries political currency. And a targeted strike projects strength internally. It deters regional adversaries, and it forces international actors to re-engage that Iran file. That's it. That's the easiest way that I can explain this and not, bring in some guy from, the New York Times to wax poetic about what he thinks and to bootlick any politicians internationally. So this seemed inevitable. And the question was, when was it going to happen? And it just so happened that it did last night. Now, what is the implication of this, right? Well, from a financial standpoint, from a market standpoint, it obviously creates very significant knee-jerk reactions. It obviously creates this, world where everybody says, well, we didn't see this coming. Well, I hate to say this, but it seems to me that the market did see this coming because oil prices had started to wake up last week after a very sideways period. And in addition to that, we were pulling people out of our embassies in the last couple of days. So the oil market was positioned for this. And the OILU has moved, obviously 10% today. There was speculation on this. Now the question becomes, in this environment, on the OILU, which I use to track energy prices and I use to track the energy sector, how much of this is pure speculation and positioning? How much of this is short covering? And how do we trade it now? So if I'm going to now completely wipe my brain of everything that I just said about the international geopolitical story, and I'm now just going to focus on price because that's what I do. How do we focus on something like this? Well, as I've noted, When the OILU gets into overbought territory, it tends to see profit taking. And this is very important. The OILU back in 2022 turned positive in December. And at that time, one of my best friends, who was one of the largest oil traders in the world at one point, had more oil under contract than anyone else, called me in December of 2021 and said, Russia's going in. Now, no one was expecting this. In fact, no one was really talking about it. It was still very speculative. And the attack and the invasion didn't come for months later. But the oil market was positioning. And you can already see it. It was already positioning with this, particularly in an environment where interest rates were going to start rising. The expectation should have been that oil prices wouldn't have necessarily moved the way that they did, just simply on monetary policy, but they did. And now you had a huge run up. As I have said, though, as you look at these charts and you look at these technicals, you can see that when we get into these periods of overbought RSI, relative strength index, which is a price momentum oscillator, MFI, which is price and volume, when they both get overbought, that has been a time where we do see some profit taking. It doesn't mean that it's going to be inevitable. It doesn't mean that it's definitely going to happen because, as you can see, there can be periods of strong price, stronger prices getting higher, more and more pressure, more and more capital coming in, particularly in a speculative environment. But I do want to point this out. This right here is June 8th, 2022. And on June 8th, 2022, I had a conversation with a friend of mine, and we both agreed it feels like there is a risk-off event coming. And sure enough, it came about 2 weeks later. And this move right here, this break of that 20-day moving average, this sell-off started on June 8th. I sent an email out around the 9th, and I said, look, something's wrong. Momentum's gone negative, and it went negative, I believe, on the 9th or 10th. And the whole market just caved. Not just the oil market, but the SPY collapsed as well. This turned out to be the largest hedge fund sell-off in 15 years. We didn't know that until 2 weeks later after we got the information from the Commitment of Traders report. But by that point, so many people had been wiped out. This is a reminder that in these types of events, an entire sector will take the elevator up, but it will take the escalator up. Forgive me, the escalator up. I'm terrible at analogies this morning. It will take the escalator up, but it will take the elevator down. So these moves could build over the next couple of months. But I am waiting for that day. I am waiting for that day where all of a sudden, and again, you can see these types of moves that have transpired here. This is back in March. I'm looking for this. And in a geopolitical event where emotion is trumping reason and price can get very, very stretched, I want to be the guy on the other side. And I'm going to specifically be waiting for a move that takes us below that 50 and that 20-day moving average, the EMA. Now, that might not come this week. It might not come next week. It might not come until August. But it is going to come. And I will be locked and loaded. And when it is that time, you will know it because we will be actively trading that on this show. Okay. Let's see. Cool. All right. So today is a great day for volume weighted average price. Of course, every day is a great day for volume weighted average price. Who are we kidding? But volume weighted average price, if you remember, is a 1 minute magnet, right? That's how we're defining this. Now, of course, I will pull up the SPY or the SPX because that is my guiding light in this market. The SPX, we set this up on the 1 day. What we're doing here, and I need to expand my chart because this is way too small. What we're going to do is add volume weighted average price. Now, remember, that is up here in the indicators section. You click on indicators and you type in volume weighted average price. You will click that, it will come up, and then you go to your settings, which are these little tiny gear, and you make sure that the bands 1, 2, and 3 are connected. Now, I have added and changed my bands to 2, 3, and 4. And I've done that for a reason. I'm going to explain this in a moment. What I'm specifically looking at on the SPY and virtually anything that is trading, I am looking for a move that would take us down into the fourth and even fifth standard deviation. Down here is where we tend to see reversals. And as we have seen in the last couple of days, we have had these moves on the SPX where we're taken down here and then there is a violent move back up. That is covering, that is machines talking to one another, that is algorithms trading. So what we do is you keep the SPX open, you pay very close attention to if and when it gets to that point, and then you turn back around and look at the SPY. The SPY has options that expire every single day. Very highly liquid trade. And when we get down into these regions, we see these moves down, like we saw the other day, and the SPX is down in that fourth band. This is where you buy the in the money call that expires that day. And you're just looking for a reversal. Again, at the end of the day, the whole point is one directionally coming off bottoms. And you keep a very tight stop. But again, if you're in the money, you're not necessarily speculating out of control. And we have seen 100%, 200% moves in reaction to this. I like to buy 3 contracts and I start to sell as we move up back up. If we get above volume weighted average price, I am holding on to 1 contract and I will hold that contract until it moves either into the third band or we reset and we drop back down to volume weighted average price. I don't have any control over the market. I don't know which way it's going to go from 2 o'clock to 4 o'clock, but I'm just positioning myself to either make a significant amount of money or it could just stop back where we were and I can just take the gains coming off of this bottom. Everything is in play today, which is why I keep reminding you, pay very close attention to the defense names. See where defense goes this morning. You may see profit taking today. This can be a sell the news event, but you're looking for some of these stocks. Doesn't matter what it is. It could be Nvidia, it could be Apple, that if we get down into this region, short dated options in the money become a cheap, fast way to potentially make a lot of upside. But if you're disciplined and you just manage it into whatever the in the money call is expiring, and you keep a 10, 15%, 20% stop, you might have a 20% downside, but you might have 200% upside. That's the type of trade that today sets up for us. On energy, keep a very close eye on GUSH. I prefer to follow OILU, but GUSH is the double bull oil and gas production. If this gets into overbought territory, that may be the point for reversal. So when we get to those levels, I'm advising and I'm simply stating that in this environment, take the gain. If we get overbought, take the gain. The risk to the downside becomes pretty significant. We don't know what funds are going to do, and we don't know how serious their purchasing is. This could be short covering. There's really hasn't been a whole lot of real true reasons why people wanted to go long oil. Remember, we talked about this earlier this week. Hedge funds were very leveraged. You had a lot of systematic trading, and forced buying was what was happening. This could be a forced buying environment, and that is not necessarily a sustainable rally. It can lead to very sharp downturns. So if you are trading oil and if you're trading the OILU and you're looking at the names that I've talked about, whether it's Oxy or Apache, which is APA Corporation now, and we get up into these areas, right? Wished I would have held on to that call, but I didn't. But if I did, I would be selling at the open. I would be taking a 200% gain. I made a 67. That's fine. But I would be taking a much bigger gain. And I wouldn't be worrying about or chasing it or getting greedy and saying, well, what if I was able to make 250 or what if I was able to make 300? Nope. I'm going to move to cash, get liquid, and prepare for the next move. The purpose of a market is to sell. Buy for $1, sell for $2. Be very happy that you sold it for $2 and don't reminisce or think about what if it went to $3. I had dinner last night with someone who was telling me that when they have a lot of time to themselves. They like to pull out a calculator and think about how much money they would have had if they would have bought Bitcoin in 2013. If I had just bought 500 Bitcoin in 2013, that's not a way to live. That's not a way to think about markets. That's not a way to think about opportunity. Don't live in the past. Focus on the market that is in front of you because there are tremendous opportunities and you will have the opportunity to make those types of life-changing gains. They're out there. You just have to know where to look. I want to conclude this conversation with this chart. Okay. Some of my long-term gold mining holdings. Jerry, I'm glad you asked this question. Do you plan to play it to the upside as a short? When we get to overbought territory, I'm going to be paying very close attention to the OILU on its 20-day moving average. Once again, whole thing. That's all it is. OILU. And even DFEN, right? Any sector, you can see when this starts to break down, I can try to be the first person over the wall at the overbought level, or I can follow the breakdown in momentum when it falls from its 20 and its 50 day. This is the point that I prefer to wait for. This is where I prefer to trade. I will speculate here occasionally. I will definitely speculate down here. As I said, strength can continue, but when we get down here into these oversold periods, particularly RSI and MFI, both of them, that is where I'm speculating to the upside. When we get above that 20, that's where I'm being much more aggressive. And then when we get above the 50, that becomes the second leg of the trade to push even higher. And we just got this. We just had this happen with OIOU. We just had it with Apache. We just had it with Exxon. APA is the ticker that I prefer to trade on momentum in energy. I don't know what it is about Apache. I think it's just that it's cheap and it's a very liquid option chain. So, the ability for me to buy a call that I know is maybe a week to 2 weeks out that costs $1. I like that a lot more than having to pay two ticks up or one tick up. The ability to actually be in the money and it costs $100. I know exactly what that is. I don't have to think about Exxon at whatever level it is right now, and my call option is going to cost me $4 or $5. I like these cheaper trades. I like the ability to play with a couple $100 rather than requiring the exact same type of risk at a higher level. So once again, I am going to likely sit on my hands for a little bit. I've been in the XLE. I'm still in the XLE. I'm probably going to take those gains today, but I was in a spread, so that it doesn't even matter because my spread was back at the 8250, 86 level. So that's blown out. I know Brandon was trading this as well. Brandon was really on top of this. And that goes back to, what Brandon's seeing in Ghost Prince, which was the idea here that something was waking up, something was happening in positioning in the energy sector. And it just so happens that not too long after he makes this trade, we have this massive geopolitical development. It tells me that people know things. It tells me that there is no, there is information arbitrage that we don't have access to. So the best indicator and the best knowledge comes from using the tools that Brandon has, focusing on price like I'm focusing on deep currents and what's happening with Blake. We're all seeing the same thing. We're just seeing it in a different way. And the reality is we don't know what it is until it happens. Like I don't know why momentum breaks down in the market until 2 weeks later. When momentum went negative for me on August 25th, 2022, I didn't know there was a crisis in England. When the momentum went negative on June 8th, 2022, I didn't know that it was the largest hedge fund sell-off in 15 years until the market had dropped another 14% and we saw the commitment of traders report. When it went negative on March 7th, 2023, I didn't know that there was a Silicon Valley banking crisis, but the bank was gone 4 days later. We didn't know. And now, most recently in August last year, we had a negative move on August 1st, And 4 days later, you have the biggest sell-off in Japan since 1987. So we don't know what's happening. All we can do is just follow the flow, and then ultimately that crisis reveals itself. I want to point this last part out, and I want to make sure that I get through this. This is from Hal this morning, Michael Hal. This is really important. What you're seeing here is the chart of US bank reserves and what Hal has defined as the lower bound. So this is effectively where banks must hold their reserves. And anything under that red line is a very serious problem in the financial system. If you look at that top line, that orange line, that's where we were with the Silicon Valley banking crisis. That's the next tick over in the top right. This is a lower bound one standard deviation run, and Hal keeps an eye on this because this is typically where there can be problems within the financial system. Well, what is happening right now is the U.S. Treasury Department is draining its Treasury General account. That's the cash that it has at the Fed, and it's pushing money into the system right now. So liquidity is actually doing pretty well in the markets, which is calming the markets, which is what has helped lead to that VIX move down into the 16s. Repo rates are even below the Fed's target. The TGA has now dropped from 850 billion to about 277 billion. Bank reserves have gone up. When bank reserves go up, that is good for risk assets. But reserves are expected, according to Hal, to fall again in 2025 because QT, quantitative tightening, is still removing money from the system. The Treasury is rebuilding its general account, and we have seasonal tax flows coming out. The Fed is effectively, according to Hal, quietly targeting a floor for these bank reserves. And that's what you're seeing in this chart. The reason for this is you want to avoid a crisis. You want to avoid another social media panic where everybody starts running to the bank and pulling their money out. We had the first social media driven bank run ever a few years ago, even though the banks actually looked pretty sound. Here's the issue. The Treasury is issuing all of these short-term bills instead of doing long-term bonds. That creates more liquidity in the system. It acts as a form of quantitative easing. That capital finds its way into risk assets. That's bullish for the markets. So we have to pay very close attention to issuance and reserve data. But what's so critical about this is this liquidity support that they are providing because they are trying to prevent a similar event that happened with the gilt crisis. Remember, all these banks still have all of these long dated bonds that are trading well below par because they bought them at 1% and now yields are significantly higher and those bonds are worth far less. If the US 10-year went to 6%, Bank of America would technically be insolvent based on the structure of its balance sheet and the liabilities attached to it. Even though the Fed is talking hawkish, policy has been very supportive for risk assets. And this was the question that was just asked. The concern here is stagflation. And that favors gold, it favors Bitcoin, and it favors a lot of those companies that I've talked about before that are real assets that kick off cash. So highly capital efficient companies and highly capital efficient assets, pipeline companies, things along those lines. We're going to be talking more about this because this is where the conviction lies. And there's going to be opportunity in the future to use options, long dated calls, a little bit, 4 to 6 months out and play those trends. And so long as liquidity continues to expand and so long as markets continue to find accommodative support, these become really, really strong, cheap trades that ultimately can compound and lead to sizable gains. I'm going to look real quick just about questions. The FDIC is a broke joke. Okay. Thanks for your comment. Yep. Good to see you, UK Ray. 50% gains on a regular basis. Huge. More than that. Okay, cool. No, so don't sell your long-term gold holdings. Just recognize that the long-term trend is really built around the idea of continuing monetary expansion. And we're going to continue to see more and more challenges in the future. Stagflation becomes the risk. What I was pointing out is that if you are an active trader If you are a person who is trading gold, trading the GDXU, right? This is what I talked about last week. The GDX, and I'm going to share my screen and then we're going to wrap it up. The GDX is the gold miners ETF. As I have shown, when we get into overbought territory, we tend to see profit taking. I'm not telling you to sell, I'm not suggesting you sell these assets. I'm suggesting that if you are buying something in the long term and you own it for the long term and you get into these overbought positions, that becomes an opportunity for a long-term investor to sell calls on their existing position, go out 20, 30% and sell calls because the expectation is we're going to see some profit taking. And if that is the case, you're going to collect some income on your position while you kind of go through the current cycle. And ultimately, yes, we will see gold prices likely over the long term is up and to the right, but it doesn't go straight up. It goes in a stair step pattern. And if you want to exploit those stair steps, and you want to be able to take advantage of knowing when to buy more or knowing when to sell a call on your position, that's really what the focus is here with the technical side. So, yes, if you are just a trader, focus on the lines. If you are in the long term with gold mining stocks, there are optimal places to maximize your position using call options and using other strategies. And we'll continue to talk about some of those in the near future. It is 9:22. I'm going to go wander around this beautiful part of America and try to find breakfast. I think there is a Huddle House, so that will be my morning. I hope everybody has a good day. Again, Don's going to be coming up momentarily. I ask you to do me a favor, click the link and join us in for 3 trades a week. And in addition to that, I will be back on Monday and look for an email from me over the weekend for a full recap and analysis of various charts, really trying to set you up for success into next week. We'll be back again, 8:45 on Monday for TheoTrade Market Masters. I hope you guys have a great day. Enjoy your trading, be active, and take care.